So these are the commandments for investment managers. The first commandment is thou shalt not skim off the top. So skimming off the top basically is setting up an investment operation where you're either taking some percentage of fees as a fixed fee, and in the case of hedge funds, they're usually taking 1 or 2% of the top, and they're adding performance fees on top. If you're in the investment management business, what should have already happened before you set up your own shop or started managing other people's money is practice the art with your own limited assets. And if you did well with those assets, then the power of compounding is such that even a small amount of money becomes quite significant after a few years, which gives you the ability to live off that base while the assets are growing. The second commandment, thou shalt not have an investment team. Investment management is not a team sport. It's really designed to be an individual pursuit. An investing team is in many ways an oxymoron. Any two humans are going to have differing circles of competence. The third commandment, thou shalt accept that thou shalt be wrong at least 1/3 of the time. This comes from John Templeton. Basically, the investment process is one where we are extrapolating, or we are trying to extrapolate the future of a business, or the future of many businesses. One has to always accept the fact that the future trajectory of businesses and predicting that trajectory at best inexact science. And so we have to be kind of humble enough to accept the fact that even our highest conviction ideas may or may not get to where we expect to get them to. So it doesn't mean that 40% of the time I will lose money. What will happen is that at least 40% of the time I will either not make as much money as I thought, or I might lose money on some investments, or they might flatline, or they might even do better. Then we get to commandment number 4, thou shalt look for hidden PE of 1 stocks. What we want to look for is the hidden PE of 1s, which means they are a PE of 1, but they don't show up as such on a screen. So for example, and they can be a PE of 1 based on future earnings. In 2012, when I invested in Fiat Chrysler, it was trading at less than $5 a share, and the company had forecasted in 2018 that they would make about $5 a share. And actually, as we are coming into 2018, they spun off Ferrari, but if I include the whole pie, they exceeded that number. So what we paid in 2012, PE of 1, materialized in 2018. That investment went up 7 or 8x in that period. So generally speaking, when you do PE of 1s, in general, good things happen to you. Then commandment 5, thou shalt never use Excel. The investment process is really quite simple. If a company, let's say, has a market cap of $1 billion, and let's say it's trading 20 times earnings. So trailing earnings are 50 million, for example, and let's assume those are owner earnings that you can withdraw as dividends and such to keep it simple. Well, the $1 billion market cap, whether that is undervalued or overvalued or fairly valued, one can only make a judgment of that if one can figure out the cash flows that are coming out of the business between now and the next 10 or 20 years, because after that it really doesn't matter. The terminal values become too small. And so if this business is trading at 20 times earnings, and if earnings are expected to grow 10 or 15% a year, and if you have a very high degree of conviction that 10 or 15% rate of earnings growth is sustainable for a very long period of time, maybe 15 or 20 years, then you can actually, run the math. You can say, okay, year one, the earnings are 50 million, year two, the earnings are 60 million, year three, the earnings are 66 and change, and just keep going from there. And then you have to discount each of those by your expected rate of return. Because if I'm getting 55 million a year from now, my cost of capital is 20 million. So that 55 million is really worth like 44 million because I'm not getting it today. And so as I discount all those future cash flows and run those numbers, it will be very hard to get to 1 billion because the earnings are growing at 10%, but your expectation is 20. So it will be a kind of a declining future stream. Every year will be less than 50 million. The math just doesn't work. Now, if you reduce your return expectations to something like 8%, it may work. But even then, there are some heroic assumptions. And we already saw what Templeton said, that you're going to be wrong 1/3 of the time, and capitalism is brutal. So it's not going to be there clocking 20% or 10% a year for 15 years because it's just difficult in business to have that much of a runway without people coming in to take your moat away. The way we get around that is by making the math really simple. And the way we make the math really simple is we go back to PE of 1. Because then if I want to make like 25% a year, I get my money back in 2 or 3 years and I still have the business, is still producing cash, and you'll find that it'll deliver that return. And it might deliver that return at a PE of 2 as well, or 3 as well. And but once you start getting to high single digits or double digits, generally speaking, the math doesn't work so well. So the thing is that a PE of 3 on Apple might get me excited, and a PE of 10, not quite as exciting. You saw with all the math we did, we didn't even need a calculator. Forget Excel. We just did it in our heads. There is no need for Excel. Then commandment number 6, thou shalt always have a rope to climb out of the deepest well. We're going to have periods when performance is great, and we're going to have periods when performance is not so great. So, for example, in the financial crisis, 2008-09, Pabrai funds from the peak in June of 2007 to the bottom in March of 2009, the funds dropped between 65 and 70%. It's a huge drop. Basically, if my fund were worth, let's say, $600 million or thereabouts, let's say in June of 2007, by June of 2008, in order to collect a fee, it needed to be at least 636 million, 6% return, and then I get paid. Instead, the funds were below 200 million. So 600 million goes to 200 million. The base level required to earn a fee is 636 million. I am in a very deep well. I need a rope to pull me out. And what I did is I took my portfolio and I put in prices for all the stocks that were in my portfolio at the end of 2010 and at the end of 2011. So I put my best guess as what these companies would be trading at. When I looked at the numbers of the aggregate portfolio at the end of 2010 and at the end of 2011, it was well north of 600 million. Partially because I had control over what went into those cells. We need distorted reality to climb out of wells. And so what I did is, instead of focusing on the $200 million number in my mind, I focused on the 2010 or 2011 number when I was going to be in fee earning territory and life would be, great, happy days would be here again. You always need, not only in investing, but in life, a rope to climb out of deep wells. So it is a guarantee that both in investing and in life, you will find yourself in deep wells. Commandment number 7, thou shalt be singularly focused like Arjuna. So we have to simplify the world. And one of the ways to simplify it is to be like Arjuna. You focus on the business and you don't focus on the noise. So anytime we're looking at, and especially when we're looking at these PEO1 businesses, usually there's more than one cloud hanging on top of the business. There are many clouds. And also, there are always a lot of macro clouds. And also, even if there are no macro clouds, there are macro concerns. And what we need to do is we need to be like Arjuna. We need to focus on the business and only the business. And so to figure out the future of an economy is really hard. Focusing on the center of the eye of the fish is the name of the game. That's what we need to do. So do not get yourself distracted by looking at all kinds of macro things. I think you're best off ignoring all of them, because anyway, you can't predict them. Commandment number 8 is, thou shalt never short a stock. Both Buffett and Munger say that they've always been right on the stocks that they thought ought to be shorted, but they were always wrong on the timing. And the timing can get very painful. Also, the math is against you, because the maximum you can make if you're right in a short position is a double. And we're not going for doubles. And the maximum you can lose is you can go bankrupt. So there's no point making bets where the highest upside is a double and the highest downside is that you're out of the game. And then, commandment number 9 comes from Polonius. Neither a lender nor a borrower be. So basically, you don't want to introduce leverage into your life. And we want to make sure that we get to play the game, and we get to play the game for a long time. So the key is to spend less than we earn and put that difference in a compounding engine. If you're spending more than you're earning, then it's not a good thing. And finally, commandment number 10 is, thou shalt be a shameless cloner. There are many smart people who are great investors. In many cases, their portfolios are visible to us because it's required by law. And it's a great shortcut to look at what are the highest conviction ideas of some very smart people. And we have websites like Dataroma, for example, in the US, which is tracking a bunch of investors and telling you what their highest conviction bets are. And so I think cloning can be really good for your health. And that's the 10th and final commandment.
There you go. 10 commandments of investment. Although Mohnish has presented for investment manager, one can perfectly find it useful when looking out for their investment opportunity. So do you have any of your commandments or rules that you find it useful before finding an investment? I like to share 2 of my own from Warren Buffett. First one, never lose money. And second one, don't forget the rule number 1. The whole point is to find an investment that costs below the fair value of an investment. Now share yours in the comment below with others so everyone get to know different perspective. If you like our video, don't forget to hit the like button and share with your friends. Also, subscribe to our channel so that you don't miss our upcoming video about such an interesting analysis in the investment community. If you would like us to cover any specific investment opportunity, please share with us in the comment below. We would like to hear from you. Thanks for watching.